Hi, welcome back to our YouTube channel. My name is Dan, I'm Managing Director here at Riverview Portfolio, your added value accountants. Today I'm here to talk about how you can use pensions to help manage your tax position. Whether you're a company director or an individual, pensions are a really useful way of helping to reduce your tax burden. Today I'm going to run through 5 of our top tips in terms of how pensions can help manage your tax position, whether you're a business or an individual. These are some of our favourite things that we use with our clients all the time. So tip number 1 is if you're a director of a limited company, you're able to make what are known as employer contributions into your pension directly from your limited company. With the changes that have come in from April 2023, this does mean that individuals each year can put up to £60,000 into their pension in any one tax year. This can be increased by using unused allowances from previous periods. What's great about this is that they are deductible against your corporation tax. So again, with changes that have come into the rates of corporation tax, this can mean that you can get relief on these pension contributions of up to 25%. So a great way of helping people save money. Our tip number 2 relates to individuals making contributions into their pension. So this is really important that if you fall into a higher rate bracket of tax. So that kicks in from £50,270 for the current tax year that we're in, which is the 23-24 tax year. And what pension contributions therefore do is that they allow that extension of that basic rate band of tax. This effectively means that for higher rate taxpayers, it will pull more of your income out of the 40% bracket into 20%, meaning a saving on your tax bill every year for contributions that you're making towards your future pension savings.
Okay.
Following on from tip number 2, tip number 3 also relates to how your high rate band interacts with other benefits that you might receive, most notably around child benefit. So if you receive child benefit, whether you or someone in your household earns above £50,000, you will start to lose that entitlement to that benefit that you receive, up to the point at £60,000 that it's lost completely. So at that point, we'll consider with clients whether it's still worth them claiming it just to be repaying it back at the end of the tax year via their tax return. What's really important is how pension contributions interact with this allowance. So this allowance is based on what's known as net adjusted income. So even though on your pay slip or from your earnings from your company that you might be earning over £50,000, if you're contributing into a pension, this actually helps to reduce that net adjusted income. So that can reduce the impact of how much of that child benefit you have to repay, even if you're earning over £50,000. Our tip number 4 around pensions is in regards to how it interacts with people losing their personal tax allowance. So for people earning over £100,000 in a tax year, you'll start to lose your entitlement to your tax-free allowance at £12,570 for the 23-24 tax year that you can earn before paying tax. Once you exceed £100,000, you start to lose this benefit. Again, much in the same way as we've mentioned around child benefit and how it interacts with net adjusted income, pension contributions work exactly the same way at this level. So if you're earning over £100,000 as an individual, pension contributions can help to ensure that you retain some or all of your personal allowance, depending on how much you're contributing into a pension. This is really important because £100,000 is also the trigger point for when somebody might need to do a tax return. So consider the information that you provide to your accountant in regards to this, so to make sure that you're getting the full relief that's available to you. Our final tip here, tip number 5, in regards to pensions, is how you can use certain pensions to be able to buy commercial property. So certain pensions will allow you to do this. So if you're a business owner that's got business premises, office space, factories, things like that, then a pension can be used to own those types of properties, meaning that you can pay rent effectively to your pension. So you get the benefit of that accumulated within your pension whilst retaining that asset personally, but also the rent is still tax deductible in terms of any relief that you get through your company by paying it. So again, a great way of using your pension to make sure that you manage your tax position. Those are 5 of our favourite ways that we think you can use pension to help manage your tax liability. Whether, say, you're a company or an individual, pensions are a great way. And the changes that were made in the recent budget, the relief has actually got better on those pensions, so make sure that you're utilising them where possible. What's really key to note that this video is in regards to the tax relief that you can get on those pensions. But if you need to think about your pensions, speak to an advisor. somebody that you know and trust. We work with some great ones, and we'd be happy to make an introduction if this is something that you want to explore further. Thanks very much for watching. I hope you found that useful. If you did, please give the video a like, subscribe to our YouTube page and give it a share. If you've got any questions on this specific topic, please do add them into the comment section and we'll be pleased to input a little bit further, or reach out to us directly via our website and we'll be pleased to help. As always, if there's any other topics that you want us to cover off, please reach out and let us know. Thanks again for watching. See you next time.